Hey, good morning, everybody, and welcome to this Tuesday, November 18th, 2025 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats. It's a pleasure to be with all of you this morning. I do want to mention we are having having a little glitch with our website. So if you are trying to get in, just be patient. We certainly appreciate your patience as we try to troubleshoot and figure out what's going on. But I want to make sure everybody is aware of that. As far as the market goes, another rough day yesterday on Wall Street, especially on the small caps. Small caps definitely taking a little bit harder, and we've got technical damage on the charts. We had a head and shoulder top. I'll try to remember to kind of annotate that for those of you maybe that don't follow technical analysis, kind of show you what's going on there. And where at least that measurement would point to. We still do have some additional downside. We are seeing futures red this morning. And so we'll take a look at some key areas or levels of support maybe that we should be thinking about in the days ahead with any additional selling. It looks to me, the way the market's trading, like we're not going to get a rate cut. I was looking last night, and I think the odds now are down to 47%. Just a week ago, I think the odds were 75%. So they've come down a lot in the last week. I think part of it is just the lack of data. Some would still point to, maybe stubborn inflation. Although, again, I think inflation is doing almost essentially what the Fed expected it to do. A year or two ago, when they were talking about it coming down, they said it would hesitate for a while, and it probably wouldn't be until 2026, 2027 before we actually hit the target of 2%. So I don't know. I feel like we're not under a lot of threat from inflation. I think it's maybe not at the target level, but certainly it's way off the highs. It's worked its way back down. I believe that the right course is to continue cutting rates, but that's just my opinion. I don't have a vote. So like all of you, we just sit on the sidelines and watch, and we can kind of cast our own vote personally, and it is what it is, right? I mean, you just have to follow what's going on in the market, which is what we try to do, and see what the charts are telling us. And I think right now the charts are saying you want to be really careful. I mean, we got a volatility index. I don't think I have that pulled up on any of my charts, but I'll try to remember to pull that up during the show. But the volatility index back up into the 20s. And I can only tell you that historically, a lot of bad things happen when you get into the 20s, especially when the VIX is rising. So as fear continues to grow and you got more and more indecision among many of the Fed officials, do we cut? Do we not? That's going to be an uncertainty that Wall Street just simply isn't going to like. It is what it is. But we as investors have to figure out what to do with our money. So it does matter to us. Anyhow, let's go ahead and take a look at the action from yesterday, and then we'll get this party started here. A lot of red. The only green you see down there is the volatility index, which finished up 13% yesterday, closing at 22. When we did see a little bit of a bounce recently, I said that the VIX didn't get down far enough. We're still in that area where we had to be careful. I think we definitely stayed above 16. I think for the most part, we stayed above 17. And so when we're moving up, we go into the 20s and then we kind of come back down. That 17 to 20 range is kind of where I think it makes sense to still remain nervous when the VIX is sitting in that area. Now, when the VIX starts to move lower, and especially when it drops down below 16, that historically has been a signal that, it's not the, full speed ahead for the market, but things are improving quite a bit from a sentiment perspective. And, a bear market or correction, but especially a bear market, requires a certain element of fear, of panic in the air, and a VIX that moves back down below 16 after it's been elevated is normally a sign of a lot of that fear dissipating. And as a result, usually the bull market just kind of picks up and moves on, continues moving higher. When you stay in that 17 to 20 range and you don't fall out of it, and then you go back up above 20, it's almost like having a little bit of an earthquake and then having an aftershock. You got to be on guard for aftershocks, and that's what we're in right now. I can't tell you how bad it's going to get. I don't believe that this is a longer term issue. I've said that all along. When I look at all of my sustainability ratios at the most recent high, all of my sustainability ratios were at highs as well, or just about every one of them. I think the mid cap growth versus mid cap value was slightly below a high, but everything else, and what that tells me is that there was risk on. It was a risk on mentality that sent the market to a high. That is usually a really good sign for the more intermediate to longer term outlook. Short term, market can pull back anytime, and that's what we're dealing with right now. And I think it's only a short term issue, but I think it's a little bit right now anyway. It's a little bit more of a short term issue with small caps than it is with the mid and large. Well, more than the large caps. Mid caps also having some difficulties as well. But anyway, looking at the screen, you can see the Dow Jones yesterday down 557 points. That was more than 1%. S&P down 0.9%. NASDAQ over 0.8%. Drop down here to the mid caps and small caps, and that's where you can see a little bit more damage. The S&P 400 mid cap down 1.8%. Small caps, S&P 600 down 2.2%. But like I said, volatility index shooting higher and back up well above 20. Which always makes me nervous and usually sends me to the sidelines, which is where I am sitting right now. I don't like taking chances when the market is like this. I don't care what my long-term signals are. I'm a short-term trader. So long-term might be great, but if I keep losing money in the short term, it's not helping me. So that's why in the short term, when I get a volatility index up, and a lot of people love this volatility, they think it's a great opportunity to make money, and it is. It's also a great opportunity to lose a lot of money. And that's the part that I don't like. And if you're a trader, that's what you don't want to do. You don't want to lose your capital. Capital is your product. That's what keeps you in business. So when I get a VIX that's up over 20, and I've done studies, by the way, when the VIX closes over 20, you generally do not want to be in the market. That's when the worst action happens, when we're over 20. Now, some people say, well, they'll counter that, argue it and say, well, when we bottom, the VIX is high, and that's the best time to be in the market. And I would say, yes, if you know exactly when that VIX bottoms, perfect, get in. That would be the perfect time to get in. The problem is it bottoming at 22, or is it going to bottom at 25, or is it going to bottom at 35, or is it going to bottom at 50? Because if you think it's bottoming at 22 and you get in and it goes to 50, you're going to lose a lot of money. Because you don't lose a lot of money when the VIX is going from 13 to, say, 15. Or 13 to 18. But you do tend to lose a lot of money when you go from 22 to 30 on the VIX. So anyhow, you just have to understand that as that VIX rises, what's going on is market makers are pricing options much more expensively. And they do that because the volatility is so extreme. They require more money, more premium on these options in order to facilitate all these trades. With such crazy volatility. So as you have bigger moves in shorter periods of time, options can move in value quite a bit. And so market makers protect themselves with higher premiums. And as the premiums go up, that's what drives the volatility index. Anyhow, so my takeaway from all this is when the VIX is above 20, I don't try to be a hero. I'm not, if I see like an extreme in the put call ratio, then yes, I might start to look for bottoms. I might start, nibbling, starting to try to be a little bit of a hero, but I got to see some signals telling me that I think we're reaching an extreme level. We're getting, some sort of capitulation, massive volume, huge move down, big reversal. I mean, look what happened back in early April with the big reversals. That's what happens when you get to a market bottom. Everybody throws in the kitchen sink and just, exits everything. And then market makers, Wall Street, the big money comes in, swoops in. You get this big reversal. They're buying everything that everybody's selling, and we mark a bottom. Now, I'm not sure we're getting to that kind of a decline. I don't think we are. But could the VIX go up to 25 or 30 before we see a bottom? Yeah, 35. Yeah. I've seen pullbacks, just kind of regular pullbacks, maybe that get to the correction level, 10%, or maybe close. where the VIX moves up into the 30s. Part of it is that the VIX was already elevated. People were already nervous and fearful. So if the VIX is already elevated and we're starting from a high level, then you can have a 5 or 7% correction, 10% even, and the VIX can shoot up easily into the 30s, maybe even touch 40. So I don't know where that VIX is going, and I don't think really that's important. I think the important part is understanding, at least from my opinion, in my opinion, that this is not a long-term thing. This is a short-term thing. That definitely changes my approach in terms of trying to spot a bottom and trying to get back in sooner rather than later. If you think that there's going to be problems down the road and it might last 3 to 6 months, you're not really worried about a bottom this week or next week because you feel like there's still going to be a lot more down the road. So my mindset is no need to rush. In this case, because I do think it's more temporary, if I can get back in where I think is more appropriate, then it makes a lot of sense to do that. All right, let's take a look at futures real quick. So we got the diamonds here. I pull those up. So right now we're looking at about 0.75% on the diamonds. The spider, about 0.5%. QQQ, about 0.6%. IWM, a little under 0.5%. But you can see just down here on this mini chart, and I'm going to look at all the charts in just a second, but you can kind of see the damage now that has been done on the IWM. We got the death cross 20-day going through the 50-day. We've taken out all these recent lows. I think a downtrend is clearly, short-term downtrend is clearly in play right now on the IWM. When we look at the others, and again, I'll bring up these charts, but you can see the QQQ has not lost the prior low from a month ago. The spider has not lost the low from a month ago. The diamond has not lost the low from a month ago. So when we're looking at this chart, it's only the IWM. Oh, I didn't mean to do that. It's only the IWM right here that's lost the lows from a month ago. So it's not broad participation of the downside. It's small caps. And I got a problem with that because small caps are one of the areas that tend to do well when we're expecting rate cuts. And that's what we were expecting. Now that we're no longer, at least I'm not expecting a rate cut in December. Why? Because the areas that normally do well with rate cuts are underperforming. So Wall Street is telling us a story right now, if we're willing to listen. And the story is that, well, let me show you the story. First of all, IWM topped, believe it or not, right when we had the last rate cut. So it was right about that time those invested in small caps said, okay, it's time to bail, which wouldn't have been the case on a relative basis if you still thought rate cuts were coming. So the seed had been planted a few weeks ago. And if you look at other areas, how about the home builders? I mean, they topped in September. So they were moving up. They should do well if the long-term rates come down, if mortgage rates come down, and the 10-year treasury yield was coming down. But then it's like sending this message that, well, maybe rates aren't going to come down anymore. And so started seeing selling in home building. How about regional banks? Regional banks do well when the short-term rates come down because as that spread widens, we start to get the uninverted yield curve and we start to get an increasing spread. Banks make more money. And I audited banks when I was in public accounting. So I do have a little bit of knowledge, fundamental knowledge that I think kind of goes along really well with the technical knowledge. But anyhow, check out what happened to the regional banks. Same time home builders started coming down, so too did regional banks. They had a horrible day yesterday. XHB breaking down, had a horrible day yesterday. IWM was the worst performer. Small caps were the worst performer when we look at all the different asset classes. So again, what this is telling me is that rates, in my opinion, the market is now saying, okay, we're not as likely to get a rate cut, and lower rates raise valuations. Higher rates or leaving rates where they are lowers valuations, especially when you've been banking on rates coming down. It's not a rate hike, but it's the reversal of what you thought was going to be a rate cut, which is basically the same effect as a rate hike. And so that is what the market is pricing in right now, in my opinion. If I look at the 10-year treasury yield, the longer term, this more reflects what we see in the mortgage rates. Right about the time the IWM topped at that last Fed meeting, that's when the TNX bottomed. 10-year Treasury yield bottom started moving back to the upside. So as the yield goes up in the 10-year Treasury, that means 10-year Treasury prices are going down. Folks are selling bonds. Well, you sell bonds for a couple of different reasons, but one would be if you truly are worried about inflation. You sell because you don't want to hold a 4% Treasury yield or Treasury bond if you think inflation's going up. I mean, inflation's at 3% now. If it were to go to 4%, you're holding a 4% bond, you're not making any money. Inflation just erodes your return. So you don't want to be in bonds when inflation's going up. You sell bonds and then the yields go up. And you don't start buying bonds until the yield's sufficient to where you feel you're comfortable relative to your inflation expectations. So seeing the 10-year Treasury yield move back up and trend above the 20, and we've got having a brain fart here, a bullish cross. It's not the death cross, it's the bullish cross, whatever. This is what happens when you start to get older. Anyway, we're getting that cross back to the upside, which in my opinion is starting to suggest that maybe the 10-year Treasury yield is trending back to the upside again. That's not what we want to see. That's not what I think the stock market has been expecting. So again, just here over the last few weeks, as the odds of a rate cut have gone from 70, 80, even 90% a few weeks back down to now under 50%, we're seeing different valuations. We're seeing areas of the market being revalued. So, eventually I think the rate cuts are coming. Once again, I think the Fed is waffling. Wall Street does not like uncertainty. They don't like a waffling Fed. They like to have confidence in the Fed. It's hard to have confidence in the Fed when the Fed doesn't even have confidence in the Fed. They can't agree. You got, all the Fed presidents and governors and everything going around having their own speeches. I think we should keep rates the same. I think we should be cutting rates. There's no unity. Normally what you see with the Fed is unity. Whatever the message is coming out of the Fed, you usually hear from all the Fed officials. Right now, under Powell's leadership, it's a free-for-all. And I don't say that in a good way. I mean, I'm not a fan. I've said for a while I'm not a fan. This dates back to 2018. Fourth quarter of 2018, we had a cyclical bear market. Let me show you. Let's go pull up this S&P 500 chart, but let's go to a weekly chart. Actually, we'll go to a monthly chart. So we can go back to 2018 right here. See the fourth quarter? That was a 20% drop. You know what the Fed was saying? Now that was the trade war. Trade war with China was really kicking in. And the Fed said that they were going to have to raise rates. And I think they said they were looking to raise rates 2 times. I wrote an article. If you go back to my article, I can probably pull it up. But if you go back to an article I wrote, and I believe it was right around Christmas. It might have been either the 24th of December of 2018 or the 26th. I can't remember which day it was. But I wrote an article and I said, Fed's not going to raise rates. I said, next move with the Fed's going to be a rate cut. And in June of 2019, the Fed cut rates. There was never a rate hike. Even though Powell talked about 2 rate hikes coming, and in my opinion, triggered an unnecessary bear market. Those who think, well, he's doing a good job. I mean, it's up for debate. I guess you can believe whatever you want to believe and you can debate whatever you want. And I'm not saying you're wrong. I'm just saying I don't agree with you. I've seen too many examples of him not getting it right, being wrong or being late, one or the other. I mean, in 2018, he was just flat out wrong and he caused a bear market. People lost a lot of money. And it's not like everybody just holds and you wait and the market comes back up and everybody's okay. A lot of people see that, they panic, they get out of the market, and then they lose a lot of money. And that's the part I don't like. I think that having a Fed chief that waffles, that has called things wrong many times in 7 years, he's the only one in 7 years where we've had 4 cyclical bear markets. 4 bear markets in a 7-year period. And I think he's responsible for 3 of them. I'm not pinning the pandemic on him. Obviously, I don't think it would have mattered who was in there. It's hard to see a pandemic coming, 100-year pandemic. But everything prior to that, I think he started in the beginning of 2018. So the bear market that occurred prior to that pandemic, I think was much the fault of the Fed. I think the 2022 cyclical bear market was very much the Fed. I mean, we had inflation starting in late 2020 into early 2021, and we didn't start raising rates until a year later. He waited. Remember, transitory. And I didn't fault him at the time. I don't think it was an easy call. I'm just saying he was wrong. I would have been wrong too. I would have said it was transitory. I thought it was more of just a supply issue that would work its way out over time. But when you print a lot of money and you send out checks to everybody, there's a lot of cash hitting the coffers. And maybe the Fed chief should have been in a little bit better position to call it. I don't know. But anyway, that whole bear market, and then he was late to the party. Then he overraised, I think, too long. And as a result, we ended up having a second leg down, if you recall. We went down. I called a bottom in June. We rallied back 700 points after that. And then it was from Jackson Hole, Wyoming. The Fed chief said, we have more pain ahead. That was on August 25th, I believe, of 2022. First of all, Fed chiefs don't have a very good history at calling the stock market. Ask Greenspan, Mr. Irrational Exuberance in 1996. And then we saw the biggest 4-year stock market rally in history after he said that. So I'm not really a fan of Fed chiefs or bank CEOs like Jamie Dimon calling the stock market. That's not really what they're good at. That's not what they should be doing. They're really good at their job. I'm not so sure that Powell is a great leader. I think he's a very smart guy, but I just don't think he's a great Fed chief. There's a lot of, I make a lot of football analogies. There's a lot of good assistant coaches. They're horrible head coaches. They know what they do really well, but when you put them in charge of everything, they're not really that good. And I think that's what's happened to Fed Chief Powell. I think he's a really good Fed official, very smart, brilliant dude. Just don't think he's a very good leader. And the fact that all of his people are going out spewing different things, there's no unity. Anyway, I could go on and on and on. But let's get back to the market at hand. Right now, I'm looking at the S&P, which has been hanging on to support. We do see futures down this morning. So I do think things could be accelerating in other areas besides just the small caps and the home builders and the regional banks. I think that it is spilling over into some other areas, but I do think that this is going to create an opportunity for another rally into year end. That's my opinion. Excuse me. So the S&P 500 trying to hang on to the recent support around 6,650 or so. I don't think it holds. I think we go back down the 6,500s. I think we challenge this low from back on October 10th. That close, I think, is going to be important. And I'll give you that number. It is 65.52. So if we go down, we fail to hold 65.52. That would really start to open the door to what I think could be then a 10% correction if we can't hold that level. So we got another 120 points, which is just a little less than 2% on the S&P down to that level. I would watch maybe if you're looking for something that could be like a capitulatory type of move, maybe if NVIDIA's earnings on Wednesday after the close, if they're not good, or if they're not up to expect, I think they're going to be better than expected, but maybe they're not as good as people expect or want them to be. So even though they're better than forecast, they may still not be good enough. And if NVIDIA were to sell off on Thursday and the semiconductors took a hit, because that's where your leadership has been coming from throughout much of 2025. If NVIDIA takes a hit, semiconductors take a hit, then I think that opens the door for some kind of a swift move down and possibly to get a correction. NASDAQ 100, same thing as the S&P. You got the double bottom here, 24.5, 24.6 for that area. Seems to be kind of a key short-term level. Then you can go back to this big red-filled candle, and that level is at 24,221. That was the close on October 10th. So do we hold 24.2? Right now, we've got 580 points, 580 points above, which is about 2.5%. Futures were down, what, about 0.6%, I think I said. So we still got another 2%, even after the potential gap down at the open, down to that key level of support, and that's what I would be watching. IWM, there you can see the big breakdown. I wanted to show you the head and shoulder top for those of you maybe that are not technically oriented. So let me annotate this. I'll show you what a head and shoulder top looks like. So what happens is during an uptrend, normally what you see during an uptrend is a high, a low, you got a higher high, you got a higher low, you got a higher high, you got a higher low, you got a higher high, higher low, higher high, higher. And that's the way trends go. Higher highs, higher lows. Well, the one thing about a head and shoulder, it starts with a neckline where you go back and you test a prior low. You didn't take it out to the downside, but it's starting to question whether or not you're still trending up, because now you've at least gone down and tested the prior low rather than printed a higher low. So let's just kind of come across right here from that low. And so what you'll see is a neckline. So this is what's called the neckline, where you've got that support, that prior low that you're testing. So here was the first low right there. And here is the one where you come down and you test it. Now, all of a sudden, we don't have these higher highs and higher lows. We have a higher low, we have the higher high, and then we come down, we have an equal low. So that establishes a neckline. Over on the left side, then you can start to fill out the rest of the pattern, because before the first low marks the, oops, that's going to be over here, the left shoulder. So here is your left shoulder. Then you come down to the neckline. Then you go up to put in the high. So you need a higher high, which we got. That establishes the head right there. You come down. Now you reach that prior low. You have a feeble bounce. Look at the PPO. No strength whatsoever on this move back up. We just flatlined right on the center line. Couldn't get through the 20-day moving average. I mean, it's really like a classic head and shoulder pattern. And we had a negative divergence, by the way, up here at the top. So head and shoulder, first we had the warning sign of slowing momentum. Then we had a topping pattern, weak right shoulder, and then we've had the breakdown. And look at the volume, confirm. Every ingredient to a topping head and shoulder pattern, including the breakdown with volume, has occurred. And so at this point, in my opinion, what becomes major is resistance at 238. That's price resistance from the neckline, and the declining 20-day moving average. Sometimes you'll see it get through the 238 level, but it can't get through the 20-day. Hits that and then goes back down. So those are the two key levels on any move back right now, is can we get back through 238 and eventually that 20-day moving average, which is declining and is at 242 right now. Major area of resistance on the chart right there. Now, what I usually expect, and what I'll do is I'll, in red, show you that from the top of the head, right about there, actually, let me do a vertical line here. So top of the head down, oops, I did not want a vertical line. I wanted a trend line, but I want to draw a vertical line. So this is kind of like the measurement. The measurement goes from the top of the head to the neckline. That is your measurement. Now, in terms of points, we're looking at about 252 down to 238, which is 14 points. 14 points would take us down to 224 on the breakdown. From 238, you subtract 14 points, that takes you to 224. So I will put a horizontal line in at 224. That is one measurement. Now, another measurement is to take the percentage. And actually, on a logarithmic chart, if we take this percentage and we just get this line and bring it down, it will then go down to the measurement, which is down right at about 224, maybe just a little bit below. No, actually, it looks like it comes right down. Maybe it's 223. Anyway, that's kind of where the target. And if you look, let's get rid of this line. But if you look, this was a major top here where we came down to the 50-day. We broke out, and then we went to another low right here. So we kind of established this support around 224 to 226. And I remember actually talking about this months ago as being key resistance that we finally got through. We tested it and we took off to the upside. So this is where I think we're heading. I think the IWM is going down probably into the mid 220s, 224 to 226. And then I think the measurement is complete. I think we would be in much bigger problem. We'd have a much bigger problem if we can't hold this level. So if you noticed, when we broke out above this high back in late June, when we did finally put in a negative divergence up here, we went back to the 50-day and we also tested price support. Then we moved up, we broke out again. And after breaking out, we haven't, ever since this move right here, we haven't gone back down to test this area again. So it looks to me like that's the level we need to look for. And then we'll go from there. I know it's 9:30, the market's opening, so let me just go a couple more minutes. By the way, if you came in late, I did acknowledge at the beginning that our website is down. I don't know if it's up yet, but we are working to restore it. So patience would be appreciated. We'll do our best to get it back up and running as quickly as possible. Couple other things, transports, you can see all of a sudden making a push back to the downside. Transports tried to get through 16.5, couldn't do it. I said, hey, we need to hold the 20-day moving average to make it look like that we are still in an uptrend. We didn't do it. So I would say we're back to this being resistance at 16.5, and we got a triple bottom support down around 15.1, and we're free to go anywhere in that range. My guess is we're probably heading back to 15.1 in the transports. I wanted to mention this. I looked back over the last month to see, how the market's been performing. And it's kind of interesting because you have a defensive group, healthcare, leading, and you also have a defensive group, consumer staples, lagging. So you got one of each, top and bottom. We've got technology, So if the market was really in trouble here, I would be expecting Wall Street to heavily be moving away from technology stocks. I mean, if you're worried about inflation, you're worried about rate cuts, not happening down the road, technology is the area you want to be out of. And so while we're going through this period where it's saying we're not going to get rate cuts and we're seeing, certain areas being revalued, other areas that from a longer term perspective absolutely should be taking a big hit, like technology, it's not happening. I mean, this is actually, we're basically flat over the last month, and there are 8 sectors that are performing worse than technology. When the market's in trouble, you're going to see technology down here when the market's trying to move to new highs. That's not what we saw back at the end of October. So I see short-term weakness. You always have to respect that VIX when it's above 20. But I do think that this is a short-term pullback. I think we're going to get the VIX bottoming. I don't know where it's going to bottom. It might be mid-20s. It might be mid-30s if things go on a little bit worse. If NVIDIA goes down after its earnings on Wednesday, that's after the close, by the way. So it would be Thursday's reaction. But I think if NVIDIA goes down, semis go down, the market takes a bigger hit, I think you could see the VIX up maybe near 30 or even in the 30s. And then we'll see more and more puts being played, and we might start to get some signals on the put-call ratio that will help us. We also have options expiring on Friday, which is going to be a whole nother curveball being thrown at the market because a lot of stocks getting beaten up. There's going to be could be potentially a lot of in-the-money put premium. We're going to be talking about that tonight at our Max Payne event that we always do the Tuesday before Friday option expiration, the monthly Friday option expiration. So November options expire this Friday. So this is the Tuesday before. So later today, I think we start at 5. I think it's 5 o'clock we start these. We're going to talk about Max Pain and what impact that could have on the market. All right. Here is, going back to last month, all of the industry groups and how they have performed relative to the S&P 500. So the best group in the market over the last month has been marine transportation. That is an extremely volatile group, so please be careful there. Drug retailers, full line insurance, pharmas. So we're getting some definitely more defensive, more value-oriented areas. Energy. Again, I was a little surprised when I saw this over the last month. Healthcare and energy, both up 5%, the only two groups up over the last 30 days. Anyway, energy there. Then we've got industrials, got renewable energy. That's been doing well. If we flip this, go toward the bottom, just get a sense of what's not been working. Wasn't that long ago, coal was one of the best industry groups. Now, over the last month, it's been 22% under the S&P 500. Not good there. Recreational products weak, media agencies, financial administration. You're going to see more of the aggressive areas. Many of the discretionary, as you can see, the XLY, many discretionary areas have struggled for sure. Which also could point to the fact that the market is thinking we're not going to get a rate cut, because a rate cut you would think would help discretionary stocks. And so if the market is going to hold off on that, money's rotating back away from those areas. But again, I think the key takeaway from today's session, at least in my opinion, is that this is going to be a short-term event, not a longer-term event. To me, it is probably not a correction. I think maybe to the extreme, we go 10%. That's kind of like the outside for me. I don't think we go more than 10%. I'd be surprised if we do. Like the IWM was up to what, 252. If we end up going down to 224, that would be $28, which would be about 11%. But I think that gets hit harder than the other areas anyway. So I think the others might lose 7%, something like that. I'm going to just say 5 to 7, maybe 8 is what I'm looking for in this pullback. We'll see. It's an educated guess. It's a guess, but a little bit of an educated guess, I guess, the way I'd look at it. Anyhow, that's what I'm seeing right now. But let's take a look and see how the market is open today. I'm expecting down, and it is down. Looks like small caps, mid caps, maybe not getting hit quite as much after taking it on the chin for these last few sessions. Certainly much, much harder than the other areas. And let's see if the IWM maybe has gone positive. It has. Not much, but, actually 2 cents. But still has put in another lower low. I don't expect this to last more than a little bit this morning. I believe we'll probably see the market turn back down again. And on the IWM, just again, remember 238 neckline, 242 is the 20-day moving average. Any kind of a move back up into that area is really just noise, in my opinion. It's still bearish. That is not going to change anything. Doesn't change it until either we get up to that, through the 20-day moving average, or to the downside, reach that target down the mid 220s. That's kind of where I'm looking. Anyhow, have a great rest of your day, everybody. Happy trading.